to Geared for Growth. I'm your host, Mike Mortlock from MCG Quantity Surveyors. Now, if you've been anywhere near the news lately, you'd be forgiven for thinking the world is about to end. Again. We've got inflation, interest rates, geopolitical tension, and plenty of headlines telling you now is the worst possible time to invest in property. But here's the interesting thing. We've heard all of this before. Go back 20 or 30 years and you'll find the same fear during the dot-com crash, the GFC, COVID, different headlines, same panic. And yet when you zoom out, property markets didn't just survive those periods, in many cases they thrived. So the question becomes, how do you separate the noise from what actually matters? And more importantly, are we sitting in one of those moments that people look back on and say, I wish I'd bought then? Today's guest is someone who lives and breathes this every day. Frank Ambesi is a buyer's agent with his finger firmly on the pulse at Fresh Start, transacting across multiple markets and helping clients cut through exactly this kind of uncertainty. In this episode, we unpack what's really driving growth right now, why regional markets continue to surprise, and how to think about investing when everyone else is hesitating. An awesome episode with Frank. Let's get into it. Frank Ambesi, thanks for joining me back on Geared for Growth.
Thanks for having me. It's a pleasure.
It's been quite some time between drinks, but I've managed to at least corner you for the next little while. And I've got quite a few things that I wanted to chat to you about. But obviously, right now at the moment, there's a few headwinds. I went to the Buyers Agents Awards last week, and there's lots of kind of fear in the marketplace. And I just kind of wanted to chat to you about that particular point. So, for example, if you look back the last 20, 25 years, there's presumably been quite a number of world-ending events like COVID and GFCs and recessions and all sorts of things. Like, how do you sort of make sense of property amidst the noise and the panic of the day?
Yeah, good question. We get this a lot, and I guess we like to educate our clients and the public to understand, when there's fear-mongering that you get from the headlines is not just to act in a fearful state, but actually just look at what's property's done during other times. And so, like you said, if you go back to like 2000, 2001, we had the dot-com crash and 9/11 and terrorist attacks and all these type of things. But then we had a massive boom ahead of us from 2000, 2006 was probably one of the biggest booms that we had in the country. And some markets grew like 200%, like Geraldton or Bustleton or Perth was like 150% during that time. So that's one example. And then GFC was also another example. In 2008, we had the massive global financial crisis, and those markets, from 2008 to 2011, they had 50 to 60% growth as well. And COVID just another good example. We have this COVID-19, people on house arrest, the borders are closed, there's no population growing, and all of a sudden we have 96% of the regions have double-digit growth, and some markets had like 50 to 60% growth over that 2-year period, like places like Wonthaggi or Orange. So I kind of go back to all those times and I say to people, look what happened during these times. Of course, there was some markets that didn't do well, but those markets that did do well. And the reason why they did do well is because of fundamentals. It's because of what was going on in the market at that point in time, and not so much what's going on in another country or what's happening with a recession or something with politics involved, because a market doesn't wait because of what's going on in a war in Iran. It's going to keep growing because of what's happening now on the ground here. So I kind of just always express that to people and I walk them through that. But hopefully people listening, they can take that on and actually look at what history has done and understand every market has its own market and it grows for a certain reason.
Yeah, and you raise a good point. Wonthaggi and Orange are a fair way from Iran, but there'll be people thinking, no, but Frank, this time it's different. The GFC, we had these record low interest rates on the back end, and it's all about the availability of credit, and we've got this sticky inflation with, the cost of goods, with diesel prices, which feed into construction and groceries and everything. This is the one, Frank. All those other ones were different. This is the one that's got to get us. We can't buy an investment property now, surely.
Well, look, I think for the ones that have that pessimistic look, they might be sitting back and not doing nothing. But how many people do we know they sit back and they've taken in what's the news have said there, and then they've kicked themselves, 5, 10, 20 years down the road, and they go, I should have got in. So regardless if you're getting now, regardless if you got in 5 years ago, there's going to be times that property market goes up and down. But a good example is, for example, if we look at Townsville is a good example. Over the last 5 years, it's had billions and billions of projects, from the hospital upgrade, university, the port upgrade. Defence Force has had a $2.2 billion training facility, and that market took off during that time, even during COVID and after COVID, where markets like Melbourne had prices went backwards in value by anywhere from 5 to 10%. And so this time, I wouldn't say it's different. I would say it's the same as every other time, but there's something different going on. And if we look at petrol prices, have come down now to $1.70, where they're at nearly $3 at one point. And so I think where you look at the pipeline and the project, what's going on in some of these areas, it's creating jobs. And especially in regional towns, I find that they've got a very high demand for people to migrate there because of jobs, because of opportunity. But you're seeing that influx happening right now, and there's a lot of people leaving capital cities. Especially, your Melbourne's has been one of the big ones, but of course Melbourne has still taken in some people. But you've got these rings like Ballarat, Bendigo, or other places that have had massive growth spurts because of these projects and attraction of people. So I think with what's going on, I don't think there's a cost of living crisis in some of these other areas in regional Australia. There is a housing shortage already. If we look at 2020, in January, there was 75,000 active rental listings online for rent, and today in January 2026 we have, I think, just around 35,000 rental properties on the market. So we're already seeing more than 50% reduction. A lot of that comes from as well regional towns. A lot of regional towns are below that 1% vacancy rate. So when you look at low vacancy rates, you look at population increasing or internal migration and jobs getting created, and there's already a housing shortage, there's still affordability. A lot of the income to house price ratio is like 5 to 7 times income. When you factor that to a Melbourne or a Sydney, some places are at 30 times income to medium house price. So the affordability isn't there.
Yeah. Now, of course, you're being exceptionally sensible and giving sagely advice, and I'm being silly, but you do kind of wonder when you speak to people and they just go, oh, I just kind of want to see what happens. And often the answer is, well, your budget is now 100 grand less than what it needs to be, or there's people that always sort of say, gosh, I wish I'd bought, during COVID, or I wish I'd bought at this particular point in time, or I wish I'd bought around the election. I can't help but feel like we are sitting in a wish I bought window.
Yeah, definitely. And I think it's quite interesting to see. I can look at some family members are like that, and we talk, around the table, because they know I'm in property. And when we go back and I listen to some of my, like for example, my uncle's an investor himself. He looks at his properties and what they've done and how much they've grown, and we sit there and we talk. And I remember having a conversation. We go, "Oh, I bought this property for 600,000. Today it's worth 1.3 million." And you're like, okay. And no one during that time, there was things that went wrong, from the GFC he went through, the Royal Commission he went through, as well COVID-19. And we forget about all that. And all we look at the end is like how much the property has doubled and what it's grown for. You forget about how much you paid for it. You forget if you paid overs or unders. You forget about during all the bad times you went through. And so property is a long-term game. And I think if people have that view, instead of going I wish, and don't become the wish, I wish, maybe look at more irrational things by looking at understanding what makes the market grow. Some of the things I've spoken about of understanding how that market works, you can remove that with logic, because the irrational way is, I guess, emotional thinking, and that unfortunately doesn't serve anyone, and unfortunately it stops you from actually taking action.
Yes, and emotions are never a good thing to bring towards a negotiation or an acquisition, are they? And I suppose once you zoom out on property market over, a 5, 10, 20-year period, these world-changing events are these tiny little blips. So, yeah, you're right. We've got to take a little bit of a long-term view. But you're a guy that's obviously got your finger on the pulse. You're buying multiple properties probably this week with you and your team. Are you noticing a change in competition? Because in pre the war in Iran, pre the last interest rates, pre all of this talk about the May budget with CGT and negative gearing changes, my feeling was that in a lot of markets, and especially some of these regions that we'll get to, competition was just absolutely insane. Are you finding you're getting a little bit less of that and better buying opportunities at the moment?
I would say yes and no in some markets. We're in some markets where it's pretty competitive and there's a lot of buyers, there's a lot of, first home buyers, and then of course you've got investors slash buyers agents. And then we do have a couple markets that we've got into where it's just before the herd gets in there, which is what we try to do here at Fresh Start. But I always say, those markets that are booming quite well at the moment, like for example, Ballarat is a good example. It's on fire at the moment. You see there's a massive amount of offers on properties, anywhere from 10 to 20 offers after a private inspection. So it's, it's still happening. And then of course there'll be markets in parts of Melbourne that aren't getting any, properties getting passed in, which is happening a lot in the east and some of the northern suburbs as well. So it's very interesting when you look at it from market to market. And so I think depending on what the price point is, I think the bottom end of the market, that sub million, is very competitive at the moment, and that can go for capital cities and a lot of regional towns that are well below the $1 million price point. And so you're getting a lot of heat in that market, which is great. And that's in places like Tasmania is a good example, Victoria, and I'd say New South Wales. Still, you've got your Queensland and WAs and South Australia's are doing quite well at the moment. But I think they've done so well for so many years now, for the last 5-6 years. I'm very hesitant to go there. And I think those markets are still doing quite well, looking at the data of what's going on.
And I wanted to ask you about some of these regional markets. And of course, there's probably going to be some of this before the herd household secrets that you've got to keep close to your chest. But broadly speaking, why do you feel like the regions have outperformed the cities? Is it a function of price point as the main driver? And if so, like, how do you sort of equate Melbourne into that? Because Melbourne's actually kind of cheap for the first time I can remember.
Yeah, definitely. I think Melbourne definitely is cheap, but I think the reason is not so much price point, but because of projects or what is going on there. When you
Yep.
look at, say, like a Latrobe Valley is a great example in Victoria. You've got the hospital upgrade of, I think, $250 million, and you got some, their electrical interconnect from Tasmania to Victoria as well, which is a multi-billion-dollar project, and a whole bunch of a handful of things, which is billions and billions of dollars, which is creating so many jobs. And then internal migration has kicked up significantly over the last, 12 months. We've seen nearly an 800% increase from the 12-month year prior. And so there's a lot of migration happening in there, which means Australian citizens moving from other parts around Australia and coming into the Latrobe Valley. So it's not so much, you hear the norm or hear these comments saying, oh, buyers agents are putting up demand. It's not so much that as well. You do have buyers agents in some of these areas, but you also have a lot of internal migration, Australian, if they're investors, Australian, people going to look for a home because they're migrating there because of work, is creating a lot of pressure on the house prices as well. So, and you're seeing that across all over the place in some of these regional towns. Burnie in Tasmania is another good example, a $1.5 or $1.4 billion hospital upgrade. That's going to create so many jobs from doctors, nurses, receptionists, security guards, you name it, cleaners. And that's just going to fuel that market even more with a 20,000 plus population size. That will, if there's 100 or 500 new jobs, that's going to put so much pressure on housing compared to a new hospital in Melbourne. That's, there's one down the road, 5 or 6 k's away, and the housing is not going to do too much there.
Now, I've heard some very clever people talk about the main levers that they see are responsible for price growth, and it's a particular case study in regions where a project can come and make a huge difference. They talk about the availability of credit sort of being the first and most obvious one. If you can't borrow money, then property's not going to go anywhere. But the second point is jobs, and you've talked a lot about jobs in the last little while, and it sort of begs the question about these regions. Is it a little bit about workplace flexibility? For example, for places like Ballarat, it's a reasonable commute to the city, so if you don't have to come in every day, or is it just more that these regions, some of them are becoming quite powerhouses in terms of infrastructure, so the job opportunities that typically people would grow up and say, one day I'm going to leave this town and go to the big smoke because that's where the opportunities are. There are actually big opportunities in some of these big regions with hospital projects and just general construction and lots of development going on in place there. The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Yeah, there definitely is. I think when we look at, commute from a CBD, say like a Melbourne, Ballarat, Bendigo is a good example. That is one factor. But I think as well, COVID's had a big shift on the market because of the work from home. And I'll give you an example. My workers, I've got a flexibility for the Melbourne team where it's, 3 days in the office and 2 days from work from home. And some are that live a little bit further out that are, an hour and a half or 2 hour drive that's 5 days from home. And so they can do their job there. And that's happening a lot more. And we're seeing that in the lawyer space. We're seeing that, all different types of sectors as well. So that has a big positive on the regional towns as well. But then also, like you mentioned, all the projects and things that we've seen as well, that has a massive, effect as well. And that's with some of these projects are long sustainable projects that are going to be there after the construction, which is ongoing jobs, which is probably the most important thing. And when I compare regional towns over the last, 5 years, we're seeing the job growth increase dramatically over the regional sector or regional towns, including as a whole in Australia, about 98% going off the Regional Institute of Australia, bringing out that article. So, which is pretty cool to see that there has been a massive increase of jobs being created in regional towns.
I think it's a good thing for the country as well. I often sort of think about the United States. If you look from a satellite and you turn the lights off, I should say, turn the sun off. I'm not a flat earther. We'll maybe aware of this. When it's nighttime, you can kind of see it's actually a fairly densely populated, whereas Australia is very, very sparse. We've got population centres in the capital cities, and even many of these regions aren't a long, long way from the capital cities. But it does kind of make sense if we're trying to solve this housing affordability issue, which I think is maybe a little bit more of an issue of rental affordability right now, but that's sort of missing its way into the rhetoric around the budget. I want to pull you back into the mud, the news and all of the doom and gloom. What impact do you think a positive or a negative budget for property would have? Or it does beg the question, do you even care when it comes to long-term fundamentals?
Not really. I don't worry about what the budget and what they do. Even if they do change of policies for the housing, for example, this capital gains tax from 50% to 25%. I feel like every time there's been a talk about with changing something, there's been an add-on to fuel prices as well, and making it more affordable for first home buyers with the 5% deposit scheme. I look at that and it's just fueled the market even more. So, and that's attracting people to go out a little bit more of the outskirts of your especially your capital cities, which you see there's more affordable housing. But yeah, it doesn't really worry me. I don't look too much at the headlines. I keep in touch and see what's going on, finger on the pulse, but I don't really buy into what's going on because I just look at what I've done and what my clients have done, and it's worked very well for them.
Let's talk about what you and your clients have done. What's really worked well? It makes me kind of think, well, of course, every buyer is different. Everyone has a different budget. If you've got someone that has, $1.5 million, that's maybe a different conversation for someone that has $700,000. But when you kind of look at property from a macro perspective, what does an investment grade property look like to you and your Fresh Start clients?
Yeah, good question. I think it really depends on the client as well, because we get some clients that even have budgets of 300,000 that they can maximum spend. So we've done a lot of research, and what we've done as well, we've bought a lot of properties back in the early days that were, some of them were units, because clients had a budget of 200,000 back then as well that could only spend. So we bought some units that done really well, like in some big regional towns where you got those 1970s, 1980 unit where you got a bit of a backyard, a carport or a garage, and they've done extremely well. Some of them are doubled in price, which has been awesome. So we've got that unit strategy that for the people that can't afford to spend that much, that works really well. And number two, you get a really good yield because compared to houses. And then I look at Houses, it's just more you're established, nothing really off the plan at all. We don't buy anything off the plan. We might buy a new property in a nice area. That's an area that there's, no green land getting released and building more properties. So I look at that. I look at, making sure there's not going to be an effect of developers coming in. And that can be for regional and capital, of course. And then we look at as well, if the client is looking for a granny flat potential, we always look for that second type of dwelling that we can put on there, which I'm doing a couple at the moment. So you can increase your cash flow dramatically. You might cost you $200,000 to put a granny flat on, and you might get $400 to $500 a week in rent in some of these areas. So when you look at the yields, it'll be cash flow positive from day one, very affordable. And so they're the kind of like the three tiers, from unit to your normal standard house, established homes, to a house that you can put a granny flat. And then, of course, we end up with blocks of units and commercial property, which is another thing that we look at. So we got, as the investor, goes from the first time novice investor, we walk through and we start going from, if it is units, we go units. If not, it's houses. Look at adding value to renovation and granny flats. And the goal is to ending into commercial. So it's kind of how we follow that approach, and we just follow with the client's goals. So we will move and pivot as time goes on.
Yeah, I wanted to sort of zero in on some of the value add strategies that you have. Of course, you talked about granny flats. Renovations can obviously move the needle as well. What sorts of things are investors chasing, and what is the motivation? Is it they might have quite a negative portfolio and they need the cash flow, or is it they're really trying to shove some value in as soon as they can to revalue and go on to the next one? What normally drives those sorts of decisions, and how successful are they?
It's a mixture of both. One is interest rates. As you can see there, you could say they're high for where they have been over the last 10 years. And so it's affordability at the moment. These days it's hard to get a property from day one to get a 6 or a 7% rental yield. So everything's around that 4 or 5%. Property's costing you a little bit more to hold. Interest rates doesn't help with that. So affordability, by doing some of these renos right away, to increase that rental income from an extra $50 to maybe $100 extra per week. So that's the one reason of why. And then two is to expand that property portfolio as well. So you get to the point where you buy your properties, maybe it's not costing you too much to hold and you're all right and your life is still great, but the banks don't look at it that way, and borrowing capacity is, at zero. Adding granny flats increases your borrowing capacity if that property starts to become neutral or positive geared, because of this strategy that you can just add a second dwelling, and then that allows you to free up your borrowing capacity and go again as well. So we're trying to be as much as proactive with the client in avoiding that happening. And even if they can't do a granny flat right away, we might buy a property that is suitable for it, and then we later on down the track will add that on. So there's a mixture of the two there of why we go down that path from the renovation or granny flat.
Thank you. That's very helpful for people that are trying to figure out when and the where for the strategies and the different types of properties as they go along that journey. You shared a wonderful post on Facebook, I think it was around about a month ago, sort of sharing some of your journey. Obviously, not everything that you've ever done has been brilliant, but you've been the sort of person that to take those lessons and adjust the strategy and not be down in the dumps about the headwinds or the wrong decisions. What sort of information do you think people right now that are just starting their portfolio journey, or maybe they've got one and it hasn't delivered the results that they had expected? What sort of parallels can you share from your story that can maybe orient them to have a more successful 26 and 27 as an investor?
Gee, that's a big question. I'll reflecting, I guess, from my journey. I guess I made a lot of mistakes and bought off the plan. Properties went backwards in value, stuck for 3-4 years, couldn't do anything. I think one of the things that helped me was I started to understand the research. And for some people, it can be very boring to do that sort of stuff. But I think this understanding how the fundamentals work in property is probably important. And then having a team around you, because the people that win in life, when I say win, I guess, or ones that are successful in life as a business or investing, they all have a team. So it's not like they do it by themselves. So if you're not the person that's likes reading spreadsheets and looking at data, that's fine. Understand a little bit of that, and so you don't get taken down a road that you get spooked to, that you make the wrong decision like I did. But then also, if someone is spoken to, you can call BS, and then you can find that right person who's that right team of yours as well, because the team is going to help you get there, and they can short track your journey. Like, for example, I'm not a plumber, but I wouldn't try and do my own pipes, so I call a plumber in to fix them. So it's very similar, but you want to have a knowledge that you're not going to get ripped off if they're overquoting or overcharging, because you understand a little bit of the kind of the emphasis of the job too. So that's kind of the philosophy that's helped me, and I kind of relate that to our clients as well, and try and give them as much value as possible and educate as well, because I think it's not taught at school. Investing is not really taught anywhere. You can read a few books that might help, but the intrinsics of it, I think, is the part where everyone leaves out of why a market actually grows and how to understand markets itself.
Mm. And for the people that are wanting just the shortcuts and they're like, when will this bloke just ask Frank where he's buying and give me all of the secrets so I could just go and do it myself? I mean, how much do you think, firstly, that's the right approach, is to start, with the hotspots rather than the strategy and the fundamentals? And I'm going to leave it open to you in terms of maybe if you want to share some areas, or at least maybe some of the ingredients about the areas that you kind of think, look, if it's got these 3 or 4 things together, then the only way's up.
I'll start with the first part, where is it, if I just share a location, is that the right approach? And the answer can be yes and no. You might get lucky and you can buy somewhere and it does really well, but as well, if you don't know your strategy, your borrowing capacity, if you're buying under the right entity, or if it's in your personal name or maybe a trust/company, these are things that we try to look at and so plan ahead. So for some clients, they might be buying under a trust, so we don't max out their personal borrowing capacity. Regardless of where you buy, if you buy it in your name, you might be stuck. So these are some of the precautions that you want to make sure you do before you go ahead. And then making sure the purchase price as well. Someone that's, like you said before, 750K borrowing capacity compared to like a 1.5 million is very different from each other. So that person with a 750K borrowing capacity is going to purchase a different asset to the other individual. So that's probably the first important part. I guess location, happy to share a few and kind of walk you through, I guess, some of the things we look at and the framework of what we look at. I guess an Albury-Wodonga is done extremely well. 2024, towards the end of the year, I started to see an uptick of internal migration. So that's the one thing that I started to see. And internal migration was increasing every single quarter. And then from there, I started to look at, the jobs that were created and what was going on. You had the hospital, which is, I think, nearly 550 million roughly of the build, or what the construction would be. And that's under construction at the moment. You've got the ATO headquarters. You've got the distribution center of Woolworths there. You've got some developments of new estates that are getting built on the outskirts because of the population increase. And there's a whole bunch of other projects that are going on there at the moment as well. So I started to put that all together with the internal migration. And then I looked at the economy. And it's so strong of an economy. I think there's about 6 to 7 industries, or maybe even more, to be honest. I haven't got it in front of me, but they're greater than the state average. So what that actually means is that it's very diverse. It's not just one single industry town running itself, like a mining town that just has mining, and if that was to shut down, the whole city will suffer. So it doesn't have that aspect. So these are the things I look at. And then, of course, I was already looking at the supply versus demand, which is basically your property data. You've already had low listings since 2024, and it just keeps reducing. So, and the affordability was there as well. So that was kind of one of the things that we looked at, and Albury-Wodonga sticks out, very, very well. But yeah, hopefully that answers your question. I think there's so many other locations. We're in about 15 to 16 locations at the moment. Predominantly everything's in mostly Victoria, Tas, and New South Wales today.
Yeah, no, mate, that's very, very generous of you to share those insights around Albury, and I suppose, Albury-Wodonga, and I suppose you've hinted at some of the key metrics like internal migration, job creation, price points, what's happening in the development space, diversification of employers, and I think that is, certainly some great advice that is transposable across lots of regions around the country. It's been a hell of an episode. Anything else you want to leave us with?
No, I think, look, this is how I learned. I think early on, I used to listen to so many property podcasts, and you listen to the gurus and they'll speak about the research side of things. Like you said, I mentioned a few really golden nuggets there, and I would write them things down. So people listening that are into property, wanting to succeed, there's so much value from, I guess, this episode, and you'll probably learn from other people that you've probably had on as well, Mike. You've had some pretty intelligent guys on that you can learn from as well. So I think just taking that in consideration, learning as you go, and implementing that into your own journey for the people listening.
And the world will end one day, but probably not in 2026, eh, mate?
No, probably before we'll be gone. Probably when the world ends. Who knows?
I think so. Hopefully.
We can talk about conspiracies if you want to. I'm more than happy. I love that. I love that type of talk.
That's a different show, but always happy. I think we might need a glass of wine for that one. But, mate, this has been a really good insight into your sort of finger on the pulse, what you're seeing and where you think people can be decisive and make some good purchasing decisions now and in the future. Thanks very much.
Thanks for having me on.
Cheers.